Welcome everyone to Daily Mortgage Rates Live with the Mortgage Calculator. We will get started here in just a few minutes. We went ahead and put up the chat on the screen, so feel free to drop a comment as you tune in. I see some people already dropping comments there. Good morning, everyone. Give us just a minute to go live on all the different platforms and give everybody a chance to jump on here. Hope everyone's been having a great week so far. Great week to close some loans. To all the loan officers out there, great topic here for today that a lot of people typically need more info on. Definitely some misconceptions about this as well. So it'll be good for Jose to go through the renovation loans for primary and secondary homes, which we will get into here in just a little bit. So hang tight with us. Again, feel free to drop a comment there in the chat as you tune in. Good morning to everybody. Mark, Rob, Adam, Samantha, Geneva, everybody tuning in, dropping comments. Shout out to the Mortgage Calculator team tuning in. All right, it looks like we are live on all the different platforms, so we can go ahead and get started here. We'll take the chat off the screen so we can get into it. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. We do this show every morning at 11 a.m. Eastern time, where we go through the actual live rates of different programs. And then we do a deep dive into a different topic every day. And today's deep dive is going to be renovation loans for primary and secondary homes. So Jose is going to do a deep dive into that here shortly, pull up some actual quotes for it. But before we do that, just like we do every morning, let's go ahead and pull up our pricing tool so we can see the live rates for today. So Nick, let's go ahead and see what the market is looking like today.
All right, let's go ahead and switch my screen and we'll get into it. So this is our pricing tool for our team of mortgage professionals. If you'd like a full loan estimate with a full breakdown, please get with our team. We have over 300 licensed loan officers in 22 states for primary and secondary homes, and we can do our investor DSCR loans in 44 states. So if you'd like a full loan estimate, please get with our team. Today, we will check out the general rates and APRs. The final cost here will be listed. And it is May 17th, just after 11 a.m. Eastern. So most of our programs are live today. So we're going to set up a basic scenario here on the pricer and see what the rates look like. Going to set the loan amount to $400,000, set the LTV to 80% loan to value. That means 20% down payment. Set the desired price to 99. That means we're going to ask the computer to find the best rate at one discount point in cost, which most customers are asking to buy down the rate a little bit. So that's the most common request. And we're going to check out our conforming, as we do every morning, conforming conventional, compare that to our FHA programs, and then check out our expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs. Remember, VA is only for our eligible veterans. If you are an eligible vet, no problem. We'd be happy to quote you up. Please let us know. But since not everybody is, we don't do that live. And same with USDA. We can quote that, but that is only for USDA eligible properties in the eligible area. So if you do happen to be shopping there, let us know. But not everybody does. So first we'll go with our conforming conventional, set up a purchase 30-year fixed standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all of our demos, we use an estimated FICO of 760 and an estimated debt to income ratio of 40. So with these basic settings, let's check out the rates this morning. Looks like a little bit higher than it was yesterday. Let's see if we have a better option down here. Nope. So 6.625 for one discount point in cost, and that's a final APR of 6.801. Remember, we always use APR to compare across the programs. So this is what we'll use to compare to the other options today. So if for any reason our customer doesn't qualify conventional, usually the next option we want to look at is FHA. So we'll go into our pricer again, set up the same exact scenario. All we're going to change is FHA, and that way we can compare across these two programs and compare the APRs to see which ones are looking good today. So let's check out our FHA rates this morning. So in this case, as with the last couple days, it looks like FHA is a slight bit cheaper here. So a 6% rate for one discount point in cost and a final APR of 6.602 this morning. Remember, conventional was 6.8. So just a little bit cheaper here. So definitely for our customers out there shopping, FHA does allow a little more leniency on credit and debt to income. But even in this case, even if you do qualify for conventional, definitely recommend to quote both side by side, because when you take all the costs into account, FHA is actually a little bit cheaper today for this scenario for this borrower. But now if our borrower is having trouble qualifying for conventional or FHA, most other banks and lenders don't have other options, but we have over 5,000 additional loan programs under expanded guidelines, aka non-QM, where we can use alternative income. So we set up our last demo here. Everything else will stay the same. However, when we choose non-QM, we can select new income options. So full doc is what we use for FHA and conventional. That's 2 years of tax returns, what most people are used to. So we usually choose this option to select a different route here. We can use assets. We've done a couple shows on that. We can use business bank statements. We can do our investor DSCR programs. We'll talk about that in a minute. We can do our personal bank statements. That's our most popular program. We can do VOEs, 1099s, P&Ls, all kinds of different variations here. But our most popular program by far is our 12-month personal bank statement. And that's for our self-employed borrowers who typically have different write-offs and things on their tax returns. So instead of using tax returns, we'll simply use their last 12 months of personal bank statements to determine a debt-to-income ratio for this loan using their actual cash bank statements. Most of our self-employed borrowers will either qualify where they wouldn't qualify at all or qualify for much more income and therefore a much higher loan amount using these programs. So these are great solutions for our borrowers who might have a little bit of trouble qualifying. So let's check out our bank statement rates this morning. And very comparable here. So the best option the computer has, 7.25 rate for one discount point in cost and a final APR of 7.330. So remember the conventional was 6.8. Right now, the non-QM bank statement is 7.3. So right there, very comparable. We love when these options are viable for our borrowers. So if you're out there shopping and you need some extra flexibility, these programs will definitely help solve that for you. And there's not that much higher cost here. And if we scroll down here, there's a bunch of different variations of bank statements. Please get with our team. They'll be able to navigate these for you. Some of these may allow things like a credit event, such as a foreclosure or things like that. So please get with our team and they can help find the best program for you. Now let's go back to our final demo. Before we go into our deep dive with Jose, we always want to check out our investment property rates. So for our final two demos, we will set the occupancy to investment for our investors out there, whether they're first-time investors or seasoned investors. We have some great options. We'll set the LTV to 80 as we have for all our demos. Everything else will stay the same. And we're going to compare our conforming conventional investment property rates to our expanded guidelines, again, non-QM. And remember, FHA, VA, USDA, we cannot use those for investment properties. So we'll simply compare these two options. So when we set conforming, everything stays the same. All we've changed here is the occupancy to investment. And we'll see what the conventional rates are this morning. So as we say every day, there has been some adjustments added to the conventional loan programs for investment properties. So the best option the computer found was 7.1, actually this option is a little bit better, 7.125 rate for 3.125 discount points in costs and a final APR of 7.372. So remember, these adjustments have made it hard for us to find an option for one discount point in cost. So most investors ask us to find an option for a little bit higher rate in order to save cash out of pocket for less discount points. So that's where we love to present our non-QM options. So let's go into our final demo here today and set this back to investment, set this back to 80% loan to value, 20% down payment again. and we will click on expanded guidelines for investment properties. Now, our non-QM options for income, the most popular option by far for our investors, is going to be our DSCR program. That's because it doesn't require any income or employment from our investors. We're simply going to use the estimated rental income from the property to determine a debt service coverage ratio, or DSCR, which is the estimated rental income. Does it offset the PITIA of the mortgage, the expenses for the home? So if the rental income covers the expenses, aka the property cash flows on a monthly basis, the DSCR ratio is 1.00 or greater. We have a ton of options for that. If the property doesn't quite cash flow on a monthly basis, where the rents don't quite cover the expenses, we still have options for that for DSCR ratios under 1. So for the demo today, I'll go ahead and delete this so that we can see all the different options. And the final setting we have is our prepayment penalty. There's always a standard 3 years for a non-QM investment property. However, we can choose 0 if we wish. That will limit the loan programs and cost more for our borrower, but it's always an option. And same with 5 years. Not all of the programs allow 5 years, but when we do have one, it does save some money, but does limit our loan programs. So for a demo, we always choose 3 years. That is our most standard option. So let's check out our DSCR rates today. So it looks like the best option the computer has here, 7.625 rate, so very comparable to conforming that you saw there, for 0.975 discount points and costs. So now we've solved our investors' concern about cash out of pocket, and the APR is very comparable. Final APR 7.705. So some great options for our investors. Most investors will choose the DSCR option compared to the conventional option. As you can see there, a lot more flexibility, no income, no employment. Our investors can start 1, 2, 5 loans at a time in order to cash out a couple properties to purchase more properties. So great flexibility here. There's a ton of different options that we have with different prepayment penalty amounts, different DSCR ratios. So please get with our team. They'll find the one that fits best for you. Some of these may allow short-term rental income and other things like that. So great options we have here for our investors. Now let me switch my screen again, and we'll get into our topic for today. So I'm going to pass it over to Jose here in a minute. But today we're going to be talking about renovation loans. So yesterday we talked about one-time close, which is buying land and building a brand new home for primary, second homes, obviously the agency options. Now we're going to present some of the renovation options for conventional. Hopefully we have some VA, FHA options as well. So there are various options for renovations for primary and second homes across most of the standard conventional FHA, VA, and USDA programs. So we'll go ahead and go into a deep dive there. This is not for our investors. We do the fix and flip stuff on the other episodes. This is for our primary and second home owners that are looking to do some renovation. So Jose, if you're ready, let's go ahead and talk about the options that we have.
All right. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Now, as Nick was stating, real important to know that these loans are for primary or second home only, and actually mainly primary, because the issue with second homes is you're going to have to be at like a 75% LTV in order to be able to get a compliant rate. And the only option that is going to be for second home will actually be the conforming option, because most of the other options, the VA, the USDA, and the FHA are all for primary residences only. So the other thing to note, real important, when you do consider that this is a build for a primary or theoretically second home, is that there are 3 components to this loan. This is very important because this is where you're going to deviate from the ground up construction, which is for an investment property. Is that in this component, in this loan, you're going to have the 3 components of you have to qualify the borrower's credit and income like any other transaction. You have to qualify the renovation, and you have to qualify the contractor. And with that being said, the borrower and the contractor cannot be the same entity. So even if you have the borrower having a LLC remove 3 layers from them, if there's any tie-in at all to the borrower and the company that is performing the construction, the loan will be denied because they need to have a separation of duties so that there is accountability for the funds. Because we usually get the question, borrower is really stoked because they're also a contractor, and like the dream, they want to build their own home, physically build it, because they want to double dip, right? They want to get the equity that you're definitely going to realize when you build your own place as the homeowner, not the actual, hitting the nails. And then they want to make money as the contractor, like they're feeding themselves. And the issue with that is not that the lenders are greedy. It's only that there needs to be accountability. We don't want anything happening with the funds. And if it does, we want to be able to go to the contractor who has liability, insurance, and all that, rather than have it all tied in with the borrower. So very important when you're structuring your deals, be very well aware that it is not possible to have a self-build on the one-time close. Now, keep in mind that that same borrower who's also a contractor, if they do opt for the one-time close, are going to have a much higher loan to value and a much lower rate and much lower overall cost, since it is a one-time close, than the type of program that may allow them to do a spec home, which is an investment property, and be their own builder. Because in that case, they're going to have maybe 85% if you're lucky on the loan to cost, and then on top of that, it's going to be a bridge loan, which is going to be due, and then either refinance into the end product if they're keeping the property, or sell it. So 2 totally different paths. So there is a definite benefit to the borrower going with the one-time close for their primary or second home. But what we're talking about here is our renovation loans, which are also for primary, second homes. And here, the benefit of these renovation loans will be to purchase a property that has issues. Or, for example, if they want to add on, you can't really add on a lot of space, but you can add on features like, redo the bathroom, make the bathroom a little bigger, shower, old kitchen cabinets. You don't want to use up credit cards for it. So you basically do the 203K or one of these other renovation loans that I'm going to show you here to deal with property conditions issues, which normally you would not be able to close on because it may present compliance issues. So very good way on those REO properties that may have missing components that would normally not allow you to close on a regular agency loan. These renovation loans will allow you to do that. Or buying a HUD REO, you can use one of these renovation loans. They have special offers for that. So with that being said, let me share the first example with you. It is a 96.5% FHA 203K. This is the most common of the renovation loans. They do have 2 options. They both price at the same rate, but they're very different. There is a streamline 203K option, and then there is the standard 203K option. The streamlined 203K option usually limits the total of the renovation at $35,000. It is streamlined in the process in that they do not require a HUD re-inspector that basically goes and re-inspects the whole job prior to the approval of the renovation budget. That re-inspector would normally go in there, and they tend to add items to the list to make sure that the home is in HUD livability conditions. And the issue there you have to watch out is that it's going to increase the cost of the renovation with components that maybe you had not considered that you wanted to renovate at that moment. So the streamline option does give that extra flexibility, but with the regular 203K, obviously you can go much higher than $35,000. What you cannot do is add on foundation, but you can definitely do a lot to the property. So really good options here. 7.125 is the par rate, and you can buy that down all the way to 5.75 at a cost of a little bit over 2 points. So if you saw the FHA rates that Nick posted a minute ago, these are pretty much the same rates. So now we have our conforming renovation. Now here we go into the realm of where a lot of people really haven't considered, right? I mean, a lot of people overlook Fannie Mae and Freddie Mac for renovation, but they're there. I mean, during the pandemic, they were a little bit stalled out, but they're back. And you're looking, pricing is a little bit higher than the FHA. 7.625 is going to cost you about 3/4 of a point, and you can buy it down to 6.625 for a little bit over 2 points, whereas the FHA was a little bit lower in rate. But then again, this is the conforming option, no upfront mortgage insurance, drop the PMI at 8, when the value reaches 80% LTV, which that's going to be pretty quick with this property once it's built. Because remember, you're setting the value now before it's even built. By the time this property's built, 9 months, 6 months, 9 months to a year, it's going to have a little bit more equity. Maybe another year or two, you're getting rid of that mortgage insurance premium. So a lot of different reasons why you'd go conventional over FHA. Now, first time home buyer, conforming renovation purchase, 97%. Now, you had not thought that you could do a first time home buyer renovation loan at a 97% LTV with reduced mortgage insurance, but yes, you can. And 7.625. Now, if you notice the rates, both of these are conforming products, but this one's 95 and it's costing $3,206. This one's 97% and it's costing $2,183, and the MI is cheaper because it is the first-time home buyer, which is Home Possible by Freddie Mac, Home Ready by Fannie Mae, and they do offer reduced MI, but you just have to look at the HUD median income for the area. Make sure you stay within 80%, unless you are in a low to moderate income census tract. Then I believe that they remove the income limitations to spur economic growth and activity in the low to moderate income areas. So again, very good option here. 97% renovation loan. Just think about it. Beat up house, close on it, and get the kitchen and baths, floorings, throw in some fresh paint, and you just added $100,000.
You do the old, you buy the worst house in the best neighborhood, right?
Absolutely.
That's what we're looking for here.
With 3% down payment. So, but it gets better, right? Because here we have 100% LTV VA renovation loan. Now, this is a great hack right here. We always feel very proud when we help our active military and our veterans. Just the other day we closed on one for one of our team's relatives, a 2-unit. So he's purchasing his primary and he's investing. And here, if you could help them help that VA person who's probably been struggling looking for that home, buy that beat up home and make it nice and beautiful. 7.125 is costing a little bit over a point, and you can buy it down to 6.5 for a little bit over 2.5 points. So VA renovation, 100% LTV. And we're not going to leave out our USDA people out there. Our USDA renovation purchase, 100% LTV as well. These are some amazing house hacks, right? Buy that beat up home on that acre out there in the ag area. 6.75% rate is costing you a little bit over a point, and you can buy it down to 6% at a little bit over 2 points for your USDA renovation purchase, 100% LTV. So many ways to get creative here. This is a great one to partner with your realtor referral partners or future realtor referral partners, because they themselves are always looking for ways to generate additional business. And if this is the angle to buy those properties with condition issues, compliance issues that would normally be a cash only transaction, well, get creative here, and you can make something out of what somebody else thought was nothing.
Awesome. Couple questions.
Oh,
Keep them
good.
coming, guys. These are complicated. Let's see here first. Can this be used for a borrower with no mortgage who wants to renovate? A refinance. He didn't do any refinance quotes, Jose.
Yeah, it was just there were so many. We're limited in time there, but you can absolutely do it if you own a property. Does it have to, whether it has a mortgage or not, right? We can refinance a free and clear property, or we can refinance a property with a mortgage. But definitely, you can do a cash out refi. Or one of these renovation refis to do work on your property.
The
Same
LTVs
guidelines
will
apply.
the LTVs will be a little bit different, obviously, because it's not a purchase, right? So just they'll be a little bit different LTVs, but definitely been used before. We've done them. And Nick got a question as well. Does the VA Reno program have any area income limitations, like you mentioned, for conforming? So I think we got a little confusion there, because conforming doesn't have limitations. The first time home buyer reduced MI does. So you want to set that straight a little bit there, Jose?
Absolutely. So let me just follow up on what you were just mentioning there. When we were talking about the 80% HUD median income limitation, we're talking about the home possible and home ready conventional loan, first time home buyer loan programs, right? Which are the ones that allow you to go up to 97% LTV and also offer MI coverage at a 25% rate of coverage rather than the usual 35% for the standard 97% LTV. So that those are the benefits for that program. And then that particular program, if the census tract is in a low to moderate income census tract, then that program then does not have any income restrictions. So your borrowers can be making more than the 80% HUD median income limit for that particular. Each census tract is going to have a HUD median income attached to it. And then the 80% figure is usually the max you can go. Low to moderate income census tract, those income restrictions are removed. With that being said, VA loans don't have any census tract related income limitations. It is simply, you run it through automated underwriting. You're going to have an idea of where you need to be for the VA loan, but we know that the VA loan is not strictly DTI based, but it is also residual income based. So you could have a VA loan with a 63, 65% DTI, but the borrower or borrowers are above the residual income minimum that's needed for a family of their size in the specific area where their home is, and then your loan will be approved. That's the key for VA loans.
So those are the area limits. So VA loans have area limits based on housing expenses and other things, but not what you are probably thinking of comparing it to conventional, in other words. But great question. All right. Okay, good one here from Geneva. Does the borrower need the contractor for each of these prior to underwriting to qualify? Great question, Jose.
Absolutely, yes. Thank you. that's just reemphasizes what we were talking about, the three components that need to be approved for each renovation loan. The contractor is one of the components that needs to be approved prior to the closing and funding of the loan. So you definitely have to have the contractor in place, and a contractor that is going to collaborate with the effort of providing all the licensing, insurance documentation, references, and provide a nice detailed estimate that is going to work for these types of loans. They can't just scratch out an estimate, 5-line estimate. Here you go, give me 50%, and I'll see you.
Yeah, the contractor is typically going to make or break your deal, so please pay attention to the contractor. Your borrower is going to be willing and able to provide documents. The contractor typically is not as willing or able. Sometimes needs to get another party involved to get an insurance document or whatever it is, right? So just be aware. Have to wait on other people. I think we covered that. Okay, here's a good one from Geneva. Can you use any of these to add an ADU or even a pool? So a little bit tricky there.
Yeah, we would have to read the guidelines on that one for each of the specific programs, because they all change. They all are different. Like the 203K, I do not believe you can use it to add square footage, or should I say, to add foundation. If you're doing an ADU, for example, I think you're going to need to pour some new foundations. So again, they theoretically, your only limitations on the amount you can spend is going to be based on the ARV of the build, right?
Exactly. You can't buy a pool if it's going to cost more than the value it adds to the home.
Yeah,
So
so
yes, you can, but
yeah. So that's the one thing I guess we should have mentioned regarding these. When you do order the appraisal, just like similar to the fixed flip loan, it's the same concept. It's just that the renovation loan is, you would consider it, similar to the fixed flip loan. You're adding on, improving the property, but in this case, they're keeping it. So you have to order the ARV appraisal similar. It's going to be, for example, specific to the product. If it's a conventional, they have a specific number. If it's the FHA, they have a specific number, but it's going to have an ARV component, and you're going to have to upload, not just, for example, if it's a purchase, you're going to have to upload your purchase contract. You're going to have to upload the scope of work, the estimate of the work and all that kind of stuff, so that the appraiser can then look for comps that are going to be suitable. Yeah, you're going to have remodeled bathroom, remodeled kitchens, going to be all painted, this and that. Then they're going to look for suitable comps, and hopefully the numbers add up.
And remember, things like pools don't always add up on appraisers, right? Just because he's in the future, the appraiser is going to say, yes, it has a pool, so the comps will have a pool. But those adjustments don't always equal cash value, right? So if the pool costs $50,000 to build, but the appraiser comes out there and says it's only going to add $20,000 in value, that's not going to work ever, right? It's just not going to pencil out. So tricky loans for sure.
Yeah.
All right, I think that's it for questions. You want to wrap it up here, Kyle?
Yeah, absolutely. Great programs there. I've actually done one before myself. I can contest that it's all going to depend on the contractor. Definitely not an easy process. But great things here. Again, something like this, just like our non-QM program, something that you need to have a consultant walk you through, right? So if you want to be paired up with one of our loan officer consultants, you can visit us at themortgagecalculator.com. We have over 300 licensed loan officers throughout all of the different states, and we can do these types of loans in 22 states that we are licensed in. Now, we do this show 11 a.m. Eastern time every morning, where we go through the different rates and then do a deep dive into a different topic like we just did today for the renovation loan. So make sure to tune in daily so you can see how the rates fluctuate in the market every day and keep a tab on what is going on here. But thank you, Nick. Thank you, Jose. Thank you, everyone, for tuning in. And we hope to see you tomorrow at 11 a.m. Eastern time for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.
Thank you, everybody.